Welcome to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
And when she went to the casino, she goes up to the table and she puts $100 down. And the guy there says, okay, well, you could win 10 or 20%, but you could lose 50%. She immediately picked up her $100 bill and walked away from the table. That was not what she wanted to do. She was not willing to take that risk and gamble in that way. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. And today we're talking about math or gambling. And AAA, you're talking about gambling. You're talking about gambling there. And when you lay out gambling that way, it makes a really easy decision. People are gambling with finances and they don't realize it. They don't understand those mathematically certain type of equations or those gambling type of equations, what they're putting on the line for what they could get in return. Would you like to explain that a little bit more?
Yeah. Well, when people are trying to make money with their money, they could go and they could buy lottery tickets, right? They could you take $1,000, you can buy a lot of lottery tickets with $1,000, but the chances of you making something significantly back in that gamble, I mean, to me, the lottery tickets are just that voluntary tax. And, the people that are doing it many times don't get anything back, or especially with how much they put in over a period of time playing the lottery, is that they often don't make their money back. And why? Because it's gambling. And there's no certainty to it. It's all risk. And is the risk worth the reward? Well, that's why, it's just $1. It's okay. I can risk $1. But what is the chances of them actually making $2 or anything like that more than the $1 that they're doing, especially if they do it every day for years? But the question is always, when you're doing something with your money, what's the risk and what's the reward? And in this example, how we started today, right? The risk wasn't worth the reward to that lady that was putting $100 down on the table. And she recognized that and went away to do something different. She probably went over to play the slot machines instead, right? But whatever. But because today we're talking and exploring the differences, the crucial differences between mathematical certainty and gambling and retirement for people in and close to retirement. $500,000 to $5 million is the range that we're talking about here. And when we're talking about this, the big thing to consider is definitions. And let's just start with that. What's the definition of math? Well, math is the science of numbers and their operations, whereas gambling is the practice of risking money or other stakes in a game or bet. So one is science and the other is a game. And when you're wanting to make money on your money, it should be more of a science than a game. Now, a lot of people that I know, here we are in Connecticut, we've got two of the world's largest, or at least it used to be largest casinos in the world here. And a lot of people will say, well, I like going to the casino and I put down $100. I take $100. And when I spend my $100, I'm done. I go to dinner when I'm done and then I go home. Right? Because it's viewed as entertainment. It's viewed as a game. They're looking at it properly. But when people are trying to do that with their 401k plan, their IRA plan, different things like that for their retirement, do you really want a game or do you want more science?
Yeah, absolutely. And I think that's a big part of the gambling is the entertainment. When you're talking about the lottery tickets, a lot of people would say, well, that's fine. That's entertainment to me. If I want to saw a movie, I would spend more money than buying the lottery ticket. And so we're not getting into if you should do that or not do that. If you enjoy spending a certain amount of money on entertainment with FanDuel, with all these betting, like all the football games, all the sports betting, people are doing that more as entertainment than they are thinking that they're going to be making some kind of big returns. The difficulty gets into with today's financial strategies, financial advice, indexing, things like this. It has more to do with the gambling, the definition of gambling, right? What was that definition that you used? Speculating.
Risking
Taking
money,
risks.
practice of risking money or other stakes in a game or bet.
Yeah. So taking risky actions for hope, right? And
Right.
typically we see that with the way people are investing their money. Now,
Right.
the whole saying, it's about time in the market, not timing the market. If you have a long time, then that's probably right. And one of the reasons that's right, as long as you don't get in the absolute wrong things, is because you're being taxed in a way you don't realize you're being taxed. And that's a tax or a theft through inflation. And so a lot of times these funds are going up in value. They're not actually going up in real terms. The dollar amount is getting bigger and bigger, but it doesn't buy you anything more. It's just basically keeping the same purchasing power. And so for long periods of time, you're just keeping your same purchasing power. It feels like you have a lot more money because the dollar amount is bigger. Does it buy you much more? We're not getting into that today, but that is one reason why people think over long periods of time that happens. When you get down into the nitty gritty and you look at true investments, the mathematical certainty is what we want to talk about today. And that has to do with getting paid, getting a return on your money that's either a promise or a guarantee to you, depending on what that is.
Right.
There's some promise or guarantee of return of your principal and a return in the meantime until you get your principal back. And that's what we want to try to cover today. So what some of those things are and how they work.
Exactly, Daniel. Very simply put, right, a mathematical increase to your money is what we're talking about today, right? And it can be very simple. And ideally, that's what we're going to do today. And be able to help you be able to understand these things in a fashion that would be actually helpful to you for your retirement. We have a paper we'd love to give you called the Retirement Risk Report, right? Will you run out of money in retirement? The retiree's greatest fear is running out of money before they run out of life. And usually it's because they keep gambling their money when they're in retirement as opposed to doing mathematical investing with it. And so we'd love to put this report in your hand and be able to help you educate you further on today's show. You listen to Financial Strategies with Andrew and Daniel Agemy because people don't know what people don't know. We want to educate you where we want to help you to be able to make smart decisions and have all the information you need to make smart decisions. If you want this paper, please call for free without obligation, 800-725-7616, 800-725-7616. Ask for it by name, RRR. All right, just think of the pirates, right? Arr, matey. All right, well, you listen to Financial Strategies. Today, we're talking about mathematical certainty versus gambling. Daniel, one of the things I think about when we're talking about this and the gambling aspect, right, and that it's a game and that it's fun, right, is what we talk about the retirement mountain, right, and how people get up to the top of the retirement mountain in a two-seater sports car. Typically, their 401k plans or whatever case may be, where they're investing in the market. And sure, there's ups, there's downs. It's fun. There's hills, there's declines. There's all kinds of things, and sometimes it's fun, sometimes it's not so fun. But overall, it gets the adrenaline going. It's a two-seater sports car. But when you get to the top, that snow-capped covered mountain of retirement, do you really want to go across it in a two-seater sports car? Or would you rather have an all-wheel drive SUV driven by a professional driver that's been there before? Well, that's kind of what we're talking about today. The mathematical approach is that's all-wheel drive SUV. The gambling approach is especially for people in and close to retirement, is the 401k plan. And so with that, or how they get to that point. So let's delve into this. Are we ready to delve into this?
Yeah, well, if we're talking about the mathematical certainty, kind of bond and bond-like investments, right? I guess we could go through some of these. There's a whole universe of these, but we picked a few different ones out. And I guess we could go through some of these and kind of explain how they work. Because we talk about bonds all the time, but there's a bunch of different types of bonds. And then we talk about bonds, and we don't always get into actually what makes them safer. I've been hearing a lot, worried about the election. It doesn't matter who you want to win. Yeah. You're worried about what's going to happen after the election.
Right.
And
right.
If you
or what's going on in the Middle East. Yeah.
Yeah. If you're set up in this mathematically, and as we go through, you'll find out why we're calling it mathematically certain way of investing. It doesn't matter because what you're going to earn. And one of the things you
Right.
say to our clients all the time, AAA, I've got this quote here somewhere. It's math. We know what's going to happen, but when it happens is the question. So we know what we're going to earn on the investments when we're talking about these bond-to-bond like instruments.
Yeah.
And the question is, when is that going to happen? Now, we're going to get into exactly why we're saying when, because there's certain things where you could make a lot more money faster than what the worst case scenario is.
Right.
But
right.
we'll get into that as we go. So yeah, let's talk about some of these different types of mathematically certain investing.
Yeah. Yeah. So this is what I want to say, because we're going to need to take a break in a minute. But Daniel, it's like when you buy something, they say when you're a real estate investor, you make your money when you buy the piece of real estate. And what that means is the idea that when you buy that real estate, you know that what you're buying it for, that you're going to make money on the deal. You actually haven't made your money yet, but you know it's going to happen. It's kind of like a certainty, right? I mean, the very simplistic way of describing that is if you're in an area where a house, the average house or median price house is $400,000 or $500,000, and you buy it for $300,000 and it doesn't need much work, well, you made money when you bought that when you paid $300,000 for that house, right? And so it's a mathematical certainty. It's a no-brainer, as we say. And so that's what we're talking about in investing. You can do it that way, as opposed to so many times I hear it over and over again. Well, I hope I'm going to be able to retire, or I hope I'm going to be able to have the money I need to retire, or I hope it's going to grow, and like we're always saying, hope is not a retirement plan. It might work for a 20-year-old, 30-year-old, 40-year-old, maybe even a 50-year-old, but when you're starting in the 60s and 70s and beyond, hope is not the way to do it. And that's how people run out of money before they run out of life, by putting too much hope in this situation, gambling. So you're listening to Financial Strategies with Daniel Agemy. Today's topic is math versus gambling. And we have a book for you today that we love to be able to put in your hand, and it's called The Most Important Thing by Howard Marks. And in this book, Howard Marks has decades worth of investing experience. In this book, he talks about what is the most important thing when you're actually investing, how to be able to really make money. And we talked about we had a show recently called about investing versus speculating. And that's what he's talking about, is investing. So I'd love to put this in your hand for free by the first 5 first-time callers at 800-725-7616. 800-725-7616. For the next 5 first-time callers, or if you're a client, please call. Anytime we have these books, if you're a client listening to the show, anytime we have these books available, they're for you. Love to put them in your hand. But otherwise, first 5 callers, first-time callers, 800-725-7616, and we'll be right back after this.
Do you have any questions for me about retirement income source?
I just want to make sure I can invest well enough to have enough income, enjoy my retirement.
We build a custom retirement plan based around your income and goals.
How do I know I can trust you?
Building trust does take time, but our investment advisory arm is comprised of fiduciaries, which means our obligation is to you, so you can enjoy your retirement with a little more income stability.
I'm in.
That's 2 out of 3.
You're locked on to Financial Strategy with Andrew and Daniel Agemy.
AAA, I was talking to a client the other day, and he's retired. He had some money that was outside of our firm that he wanted to bring over, and he wanted to do like the money he had with us. It had not been earning very much. And he said, I would like some more certainty. And so we went through different options. We talked about money market accounts. We talked about preferred stocks. We talked about common stocks, and we talked about the difference. And he said, my biggest thing is I would like my principal not to be volatile. And I would like to be able to create enough income off of that to cover my required minimum distributions. And I said, that's not too bad. We can do that. And we went through those different options. And people think of certainty of something like a money market account, right? Because you're going to earn 5% or 4.25% or whatever it is right now. The difficulty is there's not a lot of certainty there. There might be no volatility of your money, but there's not a lot of certainty because if rates cut, that's the first thing to lower. So we went through how if you look at, for example, a corporate bond, you can lock in an interest payment for a certain period of time. Now, there might be more volatility, the account value going up and down, nothing like you would get in the stock market, but you have the certainty of the payment. And that was something he was like, wow, this is super interesting because I can cover my RMD for X amount of years, whatever we're talking about going out with the bonds. And he was thrilled to death with that type of thing. We also went through that there's two ways to make money in those bond and bond-like investments. I'm Daniel Agemy.
And I'm Andrew Agemy. You're listening to Financial Strategies with Andrew and Daniel Agemy. This father-son team coming to you because people don't know what people don't know. There's not enough people educating people. A lot of talking heads, but not a lot of education going on. A lot of information, but not a lot of education and effective communication going on. So we're here talking to you today. And today's show is math versus gambling, or mathematical certainty versus gambling. And we love to be able to talk to you today. We're talking about this. And Daniel, that is really interesting what you're saying. When you're talking about those bonds, right? And we talk about those government bonds like that. What I love about them is, and people don't understand bonds. So how many times do people talk badly about bonds because the press talks badly about bonds and they're talking, oh, the bonds are losing and whatnot. But that's because the press doesn't know what they don't know about bonds, and because they're just fed stuff by stock market people. And it's real interesting in our listening audience, when we were preparing this show, and we use AI a little bit to be able to help us with that, which what the AI does is takes the information that's out there on the internet and searches it to be able to give you what you're looking for. When we were asking for information about individual bonds, it kept coming back about bond funds. And we're going to give you a paper that tells you the difference between bonds and bond funds. But so the point is that all the information on the internet, you're getting better information here right now than the and that goes to show that it's a different way of doing things. And actually, this is something that people did in the 40s, the 50s, the 60s. Now, with those bonds, the great thing about those is what makes a bond safe is being able to hold it to maturity. Because at maturity, the government will pay you back. If you buy a $10,000 government bond, at maturity, they're going to pay you $10,000, much like a CD in that point. What Daniel said a moment ago in regard to your account value can vary, and that's true, because it's what can you sell it for in between that 10-year period of time. And not that you want to sell it, because if it drops in value to $9,000, $8,000, why would you want to sell that? Hold it to maturity to get your $10,000 back, especially if you're getting 5% or whatever to cover your RMDs on that. Because if you got a $10,000 bond for 10 years, you get $500 a year at 5%. And so over that 10-year period of time, right, you're making $5,000. You get your $10,000 back at the end of the 10 years. Now you got $15,000, and unless you got more because you reinvested the 500, but it's compared to a CD. And as a matter of fact, if we're talking about government bonds, that's even safer than a CD, because the U.S. government bonds are seen to be the safest thing out there. And people say, yeah, but if they're FDIC, well, that's a whole nother conversation. And who's the FDIC? Ultimately, it's the government, right? So, but bonds safe compared to bonds to stock. And the reason why they are, when we're talking individual bonds, is because you can hold them to maturity, like Daniel said. And when you hold them to maturity, you get your principal back. Doesn't matter what's on your account statement in between now and maturity. What matters is how much you get when it matures. Well, you're listening to Financial Strategies with Andrew and Daniel Agemy. Today, we have a paper to be able to give you to go along with what we're talking about, called bonds versus bond funds. And people oftentimes use the word bonds when they're talking about bond funds, and it's a totally different animal. Your kids at 15, 16 years old, hey, are you done cleaning your room? Or are you done with your homework? Yeah, I'm done. And then you go check, and it's not done at all. It's a different definition for the same word. And so same thing with this. We got this paper to help you understand the definition of bonds and bond funds. So we'd love to give that to you, 800-725-7616 for your free copy. You're the 800-725-7616 for your free copy of Bonds versus Bond Funds. You listen to Financial Strategies with Andrew Daniel Agemy, this father-son team, talking today about math versus gambling.
Triple A, when you're talking about these bonds, typically how a bond works, if we take a U.S. government bond, you could buy it for different increments of time. So let's say it's a 10-year bond. And what that means is typically they're sold $1,000 a bond. So you can buy those bonds at a discount. So you could buy that $1,000 bonds for $800, for example. And if that's a 10-year bond, at the end of 10 years, you'll get $1,000 back for the $800 you paid for the bonds. Now, some people might say 10 years sounds like too long. And I would probably say I agree with that in today's environment, because even though rates are lowering, and you would think if rates are lowering, the value of the bond would be worth more, but because the deficits are also blowing out, people might want more return because the return of principal or the return in 10 years is less certain than it would be if we didn't have huge deficits. Now, the U.S. government, you don't have to worry about because they have a money printer. And if you can create your own money, you cannot go bankrupt. It would be like if you, AAA, were offering Andrew bucks and you could create as many of them as you want. You could borrow as much money. As long as people wanted that money, those Andrew bucks from you, you could create as many as you wanted and be able to return the principal. So that's kind of what the U.S. is doing. As long as they have a money printer, they can always return your principal. Now, what that can buy is a different story, but they can always return the nominal number.
Right. Yeah, that's a good point, is that so when we're talking about these bonds and things, that is one of the many things that helps us to be able to understand the difference between math and gambling. And when we're talking about this, and when you buy a $10,000 bond, well, the math is the $10,000 bond, whatever you pay for it, you're going to get $10,000 back at maturity. So if you paid $8,000 for that $10,000 bond, the math says you're getting $10,000. You're going to make 20%, you're going to make 25% growth at maturity. Because if you bought it for $8,000 and received $10,000 at maturity, that's $2,000, which is 25% of $8,000. So the math says you're going to make 25%. And if that happens to be a 5-year period of time that you hope that before maturity, well, just in growth, you made 5%. If you happen to have a 5% yield to it at the same time, well, you actually made 10% in that deal per year. Amazing stuff. Amazing mathematics.
Yeah. And so there's a lot of different strategies. And as we go, we'll go through, there's different mathematical equations for calculating your return on these, on bond and bond-like instruments. And so there's some different, right? There's current yield, and people get confused with these. So we'll explain how these things, current yield is different than yield to maturity, which is different than yield to call, right? And you can make different money. And that's why when I quoted you earlier, talking about you saying, we know what we're going to earn, we just don't know when. It depends which one of these things happen. If you get stuff called early, you usually make more money, and different things like that. So if we talk about the different types of bonds, typically they're selling at $1,000 par. So you spend $1,000 and then there's a coupon on that. The coupon is what you're going to collect. And typically these bonds are paying twice a year. So you'll get 2 payments per year. And these are on the government bonds typically, right? U.S. government bonds. You could do corporate bonds. So you go look at corporations like maybe Exxon or Coca-Cola or Apple, right? And there's different corporations that will offer bonds. And again, how the bond works is you have a contract with the company or the government where you loan them your money for a period of time, which is a contract. And at the end of that period of time, they return your principal. And in the meantime, you collect those 2 payments per year of whatever your interest payment will be.
Excellent.
So you can look at corporate bonds, you can look at government bonds. We'll get into some other types of investments that we like that are less known, which would be baby bonds. There's There is whole life insurance, which can provide some guarantees on death benefit, but also tax deferred growth and has potential for dividends. So there's guarantees associated with that, as well as preferred stocks, which are a little bit lower in the capital structure, but still higher than common stocks. And these things pay really nice dividends as well. And then there's some other CD lookalikes, fixed annuities that can do some things for people. They can protect against longevity, and they can provide streams of income as well. So we'll get into those things as we go through the show.
Oh, cool. I can hardly wait. Listen to Financial Strategies with Daniel Agemy. It's time for us to be able to take a break here. And we have a report. We have a book actually that we'd love to put in your hand. And this book is called The Most Important Thing by Howard Marks. And this is an easy read book that we'd be able to help you understand things like the 6 foot tall man that drowned to death in 4 foot on average water, right? And different things that will be able to help you, give you understanding of be able to how to prepare and the strategies behind being able to retire, stay retired, and not outlive your money. We'd love to put this in your hand for the next 5 first-time callers at 800-725-7616, 800-725-7616 for your free copy of The Most Important Thing by Howard Marks. If you're a client, please call 800-725-7616. All for you. Free for you. Okay, call now.
Time for some tough questions for these financial advisors. What makes Retirement Income Source different from other financial?
Our extensive experience generating investment income quickly so you can have financial peace of mind, navigate your retirement smoothly, and have more time to spend with family and doing the things you love.
We gotta talk to these guys. We're done here.
This is Financial Strategies with Andrew and Daniel Agemy.
We retire vicariously through our clients every day. We know what it's like to be retired at 50, at 60, at 70, at 80, at 90, and so forth. And one of the things in retirement, what you need to be able to live the rest of your life in retirement is you need to be able to eat. And if you invest in roosters, you have to be able to, you're going to have to kill roosters. And there's a chance you could run out of food. You could run out of roosters. If you invest in chickens and you eat the eggs and you only eat the eggs, you'll eat for the rest of your life. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today, we're talking about mathematically certain versus gambling. And AAA, maybe we should rename the show like Farming in America or something like that. What do you think?
Yeah, exactly. Well, as a kid, you hear about the golden goose that laid the golden eggs, right? And that's what we do for people, right? And the point is that's what contracts do. That's why it's mathematics. I mean, it's math. It's not rocket science to understand that a goose lays eggs, a chicken lays eggs. And if you only eat the eggs, well, but Wall Street doesn't tout that. Right? Wall Street wants as much as our clients' money in the market for as long as possible because they make money whether the market goes up, the market goes down, or the market goes sideways. It goes 3 directions. But of those 3 directions, it goes down and sideways more often. But when do people make money? Only when it goes up. But I'm in favor, and you're in favor, Daniel, of making money all the time. And if you're investing in chickens, you're going to make money all the time. It's a true investment. And so that's what we're talking about. The eggs are interest and dividends. It's the old-fashioned way of growing your money. And it's the contractual thing. You were talking about contracts earlier, Daniel. And so many people listening to your show, if you're in our listening audience, you've either had a mortgage or have a mortgage, right? And so it's a mathematical thing to the bank. The bank says, okay, we're going to loan you X amount of money. We're going to charge you X% of interest. You're going to have it for whatever period of time, 30 years or whatever the case is. And we know when we're going to get all our money back. And we know how much money we're going to make. And if you don't pay, we're going to ruin your credit and we're going to take your equity. So we're actually going to make more money in that case. And that's exactly what we're talking about here, contracts, except our clients borrowing from the bank, they actually are the bank. They're loaning the money. You mentioned it earlier, Daniel, that it's a debt instrument where, like with the government bonds, you're loaning. If you buy a $10,000 government bond, you're actually loaning the government $10,000. And they're paying you an interest on it. Back during the war in World War II, right? They were selling bonds all the time to fund the war effort. So the government was borrowing money from the U.S. people to be able to fund the war effort. And then they paid them interest, right? And a lot of your parents, grandparents, whatever, invested in that back then because that was what every American did to help win the fight in Europe and in the Pacific and so forth. And that's what, so it came about. But the idea is it's a debt instrument. When you loan money to somebody, and if you loan money to somebody, you want a contract to say that instead of just a handshake, especially in today's day and age, right? And that contract says that you're going to get the money back. That's what we're talking about. These kinds of investments. When you buy a bond from the U.S. government, you buy a corporate bond, you buy a baby bond, you buy whole life insurance, you buy CD lookalikes, you buy a CD. They're all contracts that are going to tell you how much you're going to make and when you're going to make it. And I can hear a lot of people in the audience right now, Daniel, saying, yeah, but they're not going to pay very much. Well, that's a good point. When you're talking about CDs, it's a short-term answer. I mean, somebody told me about a 5.5% CD, but it was only 4 months.
Right. They're trying to buy your business. They're trying to buy your money. They're going to pay you extra up front and then assume that you're not going to pay attention when it's time to roll over, right? There's strategies like that these banks like to use.
Right. That's right. But it's a short-term thing. They're not making 5.5% because it's only 4%. If it was in there for the full year at 5.5%, yeah, then they make 5%. But chances are they're not going to make 5%. They're making the equivalent of 5.5% for those 4 months. But it's a short-term answer. When you're talking about retirement is a long-term situation. So you need longer-term investments that are going to be able to be there for you whenever. And that's where, what we do for people when we're managing people's money is we're always rolling them not into CDs, but other things that are going to be able to pay them. Like Daniel said earlier, the client that wanted the money to be able to fund our required minimum distribution, we keep rolling those into things to be able to make more. And in the situation of the bank, where you don't pay, the bank could make more money. There's ways that we can pay more money where we can buy those $10,000 contracts for $8,000. And then upon maturity, you make more money. Not us, you do. So it's a great thing to be able to understand this and understand how you can make good decisions to be able to do that. Well, going along with that, you're listening to Financial Strategies with Andrew and Daniel Agemy, this father-son team coming to you to help educate you so that you can make smart decisions. Because we believe a educated retiree is a happy and stress-free retiree. And with that, we have a paper that we'd love to give you today. It's called Bonds versus Bond Funds. And this paper will be able to help you understand the difference between what an individual bond is versus a bond fund, and how bond funds are risky and individual bonds are not, and how you can make money on individual bonds when you can't make money on bond funds from that standpoint. And so they work differently, they act differently. Long and short of it is bond funds are the stock of a company that owns bonds. And so if you don't know that this is a great paper to have, the egregious thing is I've met people who've been in this business 20 years that don't know the difference here. So if you read this paper, you're going to know more than some people within this industry, unfortunately, even though they have to take a test that says they know the difference. But nevertheless, you have it for free by calling us at 800-725-7616, 800-725-7616 for your free copy of Bonds versus Bond Funds. You're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is mathematical certainty versus gambling. And we're delving into what all these things are, Daniel. So what's next on our list?
So AAA, let's go back to our investor. Let's go back to our investor and let's call him Jake. So Jake, we talked about, he's going to be needing to take RMDs very soon. And and this is a new thing. How do I take RMDs? What's it look like? What do I do with the money once I take it out? There's a lot of things to consider. And he wants nothing to do with equity investing with stocks, with the stock market. He's terrified of that. He wants certainty. He wants more certainty. He wants to know what's going on. So what we ended up doing was putting together a portfolio of different bond and bond-like instruments so that he could take his RMD every year and then generate in income about 2 to 3% of income. This isn't growth. We'll go through exactly how the math is made up of this. More than his RMD, which means he's reinvesting 2% to 3% of his IRA every year, compounding, growing it after he takes out the amount that the government tells him he has to take out. And this is if markets are going up, if they're going down, or they're going sideways, right? Because the bond says, right, we're going to pay you X amount of money. And that feels really good when we live in such an uncertain world. That feels really good when so many things are changing. And we get investors who will ask questions like, well, how do you know this company is still going to be around in 20, 30, 40 years? And we say, with this type of investing, we don't need them to be around. Right. All we need them to be around is long enough and have a good enough balance sheet to repay us for if it's 5 years.
To get our money back.
We don't need them to grow over those 5 years. All we need them to be is around and have enough cash to pay us our money for those 5 years. And it makes it a lot more certain doing the analysis. AAA, you talked about it's like a bank. What is one thing a bank also does? They underwrite their credit. They won't give a loan to anybody. And that's what our clients hire us and pay us to do, is we go and we underwrite the credit. We don't give money to any company. We don't give any money to any government, right? We look at, can this company, can this corporation, can this insurance company, whatever it may be, pay our clients back? And we're underwriting those things as well. So it is a lot like a bank in that we get to pick if it's a good enough rate for the credit. Yeah. Right? Is it a strong enough company? Do we think, well, they'll be around and be able to pay us back in 5 years, 10 years, and we're not locked in. If something changes, we can get out. And that's what our clients love about the way we're managing these individual securities. Another thing that you brought up, AAA, when we were doing the research for this show, it just kept talking about bond funds. Why do you think that the AI just kept talking about bond funds? Why do you think that you never hear, unless they're talking about like trying to leverage up government bonds, you hear about that on big media shows? Why do you think your advisor doesn't talk to you about individual? If you're not our client, your advisor, whenever they say bonds or equities, almost all advisors are talking about bond funds or equity funds. And when you listen to any of these professional financial networks, why, when they're talking about bonds, they're talking about, why do you think that is? It's because they get paid on bond funds. There's internal fees on bond funds. There's money to try to sell bond funds. A bond, they get paid one time when they issue it. So when the corporation comes to the investment bankers and says, we need $100 billion, we need $100 million. Yeah. They get money on that initial bond offering. Yeah. But then the bonds sell in the open market and nobody's making money. Now, somebody's making money on brokering that, but it's a tiny amount of money. Right. And there's no cut. There's no internal fee. There's no nothing. And that's why you don't hear about it. It's not because it's not in your best interest. It's not because it's not better than buying the fund. It's because there's no money for someone to tell you about advantages of owning the individual bond compared to a bond fund. Right. Oh, Daniel, that's good. That's good stuff, man. Yeah, there's, you can make money, but not in the same way that Wall Street is used to making money and wants to make money. And that's part of the thing. So that's some good stuff you got there, man. Well, you're listening to Financial Strategies with Andrew and Daniel Agemy, and it's time for us to take another break. Boy, show's going really fast, Daniel. And we have a book for you in our listening audience called The Most Important Thing by Howard Marks. And Howard writes in this book in simple language, easy read book, information to be able to help you gain knowledge, gain wisdom, and understand strategically how to prepare better for retirement than what Wall Street is going to tell you. So we'd love to be able to put this book in your hand for free by calling us at 800-725-7616. First-time callers, 800-725-7616. And if you're a client, please call. Get it for free, 800-725-7616. Call now.
locked on to Financial Strategies with Andrew and Daniel Agemy.
Mary Ellen retired from teaching high school mathematics, Daniel. And Mary Ellen, she's a mathematician. She did some work and understood bonds because her parents went through the Depression. They bought some individual bonds and so forth. She learned about bonds from them. And so she studied and understood what individual bonds are and how they work. And when she went looking and she saw that she could buy a $1,000 bond for $800 and it was going to pay her 5% interest. And so she said, mathematically, this is a no-brainer. I'm buying this $1,000 bond at maturity in 5 years from now. It's going to pay me $1,000, but right now I'm only paying $800 for it. So I'm going to make 25% in that. I'm going to make $200 and I'm going to make 5% interest over that 5-year period of time. So mathematically speaking, I'm making 5% per year plus the 25% over 5 years is another 5%. I'm going to make double-digit returns. I'm going to make 10% on that bond. Mathematically speaking, I know what I'm going to do because that's how this contract is written. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today, we're talking about mathematically certain versus gambling. In AAA, we've been talking about this. We've been talking about how sometimes people believe gambling is a good form of entertainment.
Right.
But the difficulty has been coming in where people's investments are looking more and more like gambling and less mathematically certain. And your retirement portfolio should not be your entertainment.
No.
It's fine if you want to go get some entertainment, buy some game stock, buy some other crazy things and try to ride them up. But that should be a piece of your money. You say, this is my entertainment money, not this is my retirement portfolio.
Right. You don't want your retirement portfolio to be in a game of musical chairs. And that's what that hope is, right? Is that when people are gambling, you hope you're going to do it. You hope you're going to have a chair when the music stops. And that was what I see a lot's going on out there right now with investing that people are doing, whether it's in their 401ks or it's in their IRAs, Daniel. And the egregious thing is they don't know. And that's why we have financial strategies, because people know what they don't know. And how are they going to know? Because there's not very many people out there teaching what we're teaching to people. So this is good stuff. Let's get into some of the numbers, some of the math here, Daniel.
Yeah, let's look at understanding the yield metric. So typically there's 3 different ways of measuring the return you're getting on fixed income, especially bonds, right? You have the current yield, and the current yield would be the value of the security. So you can take the annual coupon and divide that by the market price, and that's how you would come up with the current yield. So if you had
What's a coupon? What's a coupon?
The coupon is the piece you rip off and you send it in. That's where coupon came from. So it used to be bonds would give a little piece, a sheet like this, and you'd have a coupon for every 6 months, and you'd rip off the coupon and you'd mail that in, and the corporation or the government would mail you a check back, and you were good to go.
Right. So it's the interest rate.
It's the interest the amount that they're going to pay you. So the coupon in this scenario would be 5%. That means annually they're going to give you 5%. So you divide the coupon payment by the current price, and you come up with the current yield. The current yield is probably the least important number. This is typically what shows up on your brokerage statement, things like that, because it shows what the current yield is, what you're earning currently. But sometimes these can be confusing. Typically, it confuses people. They want to look for as big of a current yield or as big of a coupon as possible. But sometimes what ends up happening is if you get the lower coupon with the more capital gains upside when they buy it back from you, you get a better return. It can be confusing. So again, to figure out current yield, you take the annual coupon payment, you divide that by the current market price. An example would be if you had a 5% coupon and it's trading at $95, $950, right? You're going to earn $50 when they buy it back from you. But if you divide that $50 of interest by what you paid for it, the $950, you come up with a current yield of 5.26, which is a little bit better than the 5% coupon because you didn't have to pay all $1,000. So this is one spot where people don't realize there's a lot of money to be made in individual bonds. It doesn't work the same in a bond fund where you can buy discounted bonds. It can potentially work the same if the bond managers hold it to maturity and do all these things. But there's too many ifs, ands, and buts. If you buy your own contract, you know what's going to happen. Next one would be yield to maturity. So this is what you're going to earn if you hold it to maturity. So again, when you're buying a discounted bond, your yield to maturity can be much higher than the coupon rate. So let's just say that we had an investor who decided that they wanted to buy a 10-year bond.
Yeah.
So they go out and they buy XYZ company's 10-year bond, and it has a 4% coupon. Now, if you're listening, you're saying, well, 4% doesn't sound very good. Stock market does closer to 9% a year. What am I thinking about 4% for? Well, there's more to the story. So it's $1,000 bond. Remember, bonds sell in increments of $1,000. So you buy it for $800. So you buy $1,000 worth of bonds for $800. 20% discount. You collect your 4% coupon each year, but that yield to maturity is not 4%, even though the coupon says 4%. Your yield to maturity, when you add in the amount you're going to receive in mathematically certain capital gains and your coupon, it actually comes out to a 6.7% yield to maturity. The yield you're going to get annually, right? The yield you're going to get each year, and that's by dividing what you paid for it by the 10 years you'll hold it and the interest you'll collect.
Sweet. Sounds good. You're listening to Financial Strategies with Daniel Agemy, because people don't know what people don't know. Today's topic that we're talking about is math versus gambling. And many times when people are trying to make money on their money, they end up gambling when they could be doing a mathematical approach, more of a certainty. And we have a paper that we'd love to be able to give you today that will be able to help you understand how you can retire and stay retired. And it's called the Retirement Risk Report, RRR. And we'd love to be able to put this in your hand, be able to educate you on how you can know better and you can know for certain what your retirement can look like, or does look like, according to how it stands now, and then what you could do to change it. So we'd love to put this report in your hand for free by calling us at 800-725-7616, 800-725-7616 for your free copy of the RRR Retirement Risk Report. Call them now. You're listening to Financial Strategies with Daniel Agemy. Today's topic, mathematical certainty versus gambling. All right.
This is why you said earlier in the show, you make your money by buying it right. There's a lot of money that can be made through buying these individual securities at a discount. And a lot of people don't know about this. Now, we have to say the biggest caveat and the thing you have to be absolutely careful is that you're buying a company or you're getting a government bond that is giving you the guarantee is a solid company. They're going to turn your principal. Because if they don't, then all this goes out the window. You want to make sure that the company is creditworthy. And when I say make sure they're creditworthy, I'm not just talking about looking for a stamp by S&P or Moody's or somebody that says that's what it is.
Right.
You need to dive in and look at the fundamentals of the balance sheet.
So Daniel, let me cut in here. So I want to speak to that, right? Because don't try this at home, folks, right? This stuff, there's a lot of intricacies to this. And yeah, sure, you could go buy $1,000 bond for $800. But then the question is, what is their credit rating? Where is their credit score as a company? But more importantly than that, what are they really? right? Because Moody's and S&P during 2006, 2007, there were some of these things that were AAA rated that when 2008 and the financial crisis came, they were junk bonds. And why is that? Because it's like that fox in the henhouse. The Moody's and S&P get paid by the people that rate them. And that's not a good scenario. What we do is we check those bonds before we buy them to make sure that their ratings are good. We use an outside rating service that we pay, that they get paid from us. We have CFPs, certified financial analysts, the highest designation in the industry. We have a certified portfolio manager in Daniel who oversees the CFAs to be able to recognize. We put it through a lot of due diligence, because at the end of the day, as far as we're concerned, our clients are coming to us and looking at us for how safe their money is, not these bond companies, not the insurance companies, even though they're in the buy. We're the ones responsible to be able to make sure that's done. And you could do that at home on your own, and you can spend years studying this stuff and getting these designations and doing and trying to understand this stuff. But most people want to spend time enjoying their retirement. And so just like I used to work on my own cars, and now I don't even change the oil on my own cars now, because they're more computers than they are the car of the yesteryear. And in the same way, you get a specialist to take care of things. And so don't try this at home. It's important to be able to understand these things that Daniel is saying. It's huge. And you don't just check it when you buy it. We also check it later as things go. Like during COVID, we had owned Hilton hotels, and we sold Hilton hotels because we didn't know what was going to happen to the hospitality industry. And so in order to protect our clients, we took matters into our own hands to be able to do what was in their best interest to secure their portfolio as well as to make them more money.
Yeah, absolutely. And so when we always are touting like how you can make so much money on these bond and bond-like instruments, you can have a more robust portfolio because you have certainties backing it up. You have guarantees and promises backing these bond and bond-like instruments up. And then you have some promise or guarantee of a return on your investment as well. So you can get mathematically certain capital appreciation by buying these things at discounts, and you collect your income, which can support the lifestyle that you want at the same time. And believe it or not, folks, because there's not a lot of people doing individual research and buying these individual securities, there can be what we call mispriced securities all the time, where we see something that's trading like that example Andrew gave of the house, where everybody in the neighborhood has houses trading at $450 and there's one for $300,000. That does not happen too often in real estate unless there's something drastically wrong. But in the fixed income market, because there's not a lot of people searching for these things, we see these inconsistent prices often. And sometimes we can do one of these two scenarios where we talked about, like the yield to maturity, for example, but we see an even better potential where it has a yield to call, and it might have, instead of the 6.7 example we gave of yield to maturity, where you earn that each year until you get your money back, where we see a call feature in it where the company can buy it back from you early. And we know based on the coupon, they're going to, or they have cash on the balance sheet to pay it back. They will buy it back. And then it might take that yield up from 6.7% annualized to 8.9% annualized because it got called early, meaning the company bought it back from you early, and you just increased that yield. Now you're talking about equity-like returns, but not taking on equity risk. You're talking about these mathematically certain returns as long as the company is staying in business.
Sweet. So comparable, the market returns at half or less than the risk of the market. Amazing stuff. Pretty cool stuff, Daniel. Well, we're running out of time. We're out of time. You're listening to Financial Strategies with Andrew Daniel Agemy, this father-son team coming and talking to you, educating you on what you don't know. And today's topic has been mathematically certain versus gambling in regard to your retirement. We'd love to be able to put a book in your hand that will help you take this further and educate yourself further on the topic. The Most Important Thing by Howard Marks. Easy read book that would be a good addition for free, no obligation, by calling 800-725-7616. 725-7616 for your free copy of The Most Important Thing for the first 5 first-time callers. And if you're a client, please call, ask for it, and we'll be glad to get it to you. Well, we are so happy to be able to come to you and finish up another rendition today. It's gone by fast, but we want you to be able to be a stress-free retiree and invest for the I rather than the G. Till next time, be well.